Hello and welcome to Dart Bank Insights. I'm your host, Brendan Andrews, and today we have on Bryan Clark, who's the Senior Vice President of Mortgage Banking at Dart Bank. Bryan, welcome.
Thank you.
Can you explain what a home equity line of credit is?
Oh, sure. A home equity line of credit allows a homeowner to tap into the available equity that they have. It's a revolving line of credit, and so you can use it somewhat similar to a credit card where you might pay it down and then reuse it later on. So if you have equity in your home, you can tap into that for debt consolidation, home improvements, whatever needs you might have. A lot of people use it for paying for college education for a child or something like that. So there's big benefits in being able to use that home equity as a tool for one of those purposes.
Okay. Can you explain what an amortization is?
Amortization is basically the process of paying down a debt over time with regular payments. When a home buyer closes on a mortgage with us, we provide them what's called an amortization schedule. And the amortization schedule shows them with each and every payment they make, how much is going to go towards interest, how much is going to go towards principal, and then lastly, what the remaining balance will be after that payment. So that's what an amortization schedule does, is it shows that breakdown of that gradual paying down of the debt.
Explain what an APR is and why it's important.
Well, the annual percentage rate is commonly confused with what the interest rate is, and it's not exactly the same. They're two different things. When you take out a home loan, you have an interest rate that you secure with your loan, but the annual percentage rate also takes into consideration the costs that you paid to obtain the financing. So it's almost a calculation that takes into consideration the interest rate plus the upfront costs that you paid to obtain the financing. And the annual percentage rate then allows you a tool to compare from lender to lender what the best deal is by comparing the APR.
Can you explain what an escrow is?
Sure. An escrow account is an account that we set aside on the behalf of the borrower, that we pay the taxes and insurances out of. So the property taxes and the homeowner's insurance gets paid out of an escrow account. So each and every month that you make your monthly payment, part of your property taxes and part of your homeowner's insurance goes into the escrow account, in which when those come due, we pay those bills on the behalf of the home buyer to the municipality or the homeowner's insurance company. And
that makes it convenient for the customer, so
they
don't have to worry about it.
It does.
Can you explain what PMI is and why some people are required to have the PMI insurance?
Sure. PMI stands for private mortgage insurance, and this came out of back in even prior to the 1950s, late 1950s. Mortgage lenders, banks, didn't like to make loans to home buyers with less than 20% down. And so private mortgage insurance kind of evolved from that, where it enticed banks to lend to home buyers with less than a 20% down payment, because what private mortgage insurance does is it's a premium that the home buyer pays that insures us as the lender in the event that they were to default on the mortgage. So it takes away a lender's risk of default, because we have that insurance policy that's behind there that insures our risk. And so now you can get mortgages with as little as 0% down. And we're willing to do that because we know we have that private mortgage insurance policy in effect.
Well, that wraps up today's Dart Bank Insights podcast. Thank you, Bryan, for being on the show. Look forward to having you back on.
Great. Thank you very much.